time horizon. And if bonds are getting bid, it probably means that interest rates are moving slightly lower. If bonds individually test a bid, and that's a fair term, use again, then it's not, it'll pressure interest rates lower, but it'll be sort of it's a different mechanism. Let's think about it. It's a different mechanism versus the Fed coming up and intervening with, hey guys, we're going to cut rates, right? That's the point I'm trying to get at. This business understanding, right? So speaking of the Fed, we can go back over here and we can take a look at the inverted T2, which is the 2-year interest rate basically. Notice that it's all over an uptick here. So the Fed pressure tool, by you for seeing an uptick there, should be seeing an uptick out of the odds for a pause, which is absolutely the case. These are around 85% odds as of the Friday morning session. We've now moved to 92% odds, which, I don't see why it's so shocking that the market digests this. Whenever the odds are over 50% that something is likely to happen from the Fed tracker tool, I can count on one hand the number of times, less than one hand, maybe two fingers, and I can tell you the number of times that the Fed has done something outside of what the futures market has priced in. So when we have those 50% odds, I understand it represents a shifting mindset for between the participants, but I mean, why? It's just, I'll leave that be. I will not go on a tangent about that, and instead I'll save you the time. The other interesting data that we got last week, of course, was around the labor market, which gives Jerome Powell some fire coverage, basically say, hey, higher for longer is fine because the labor market's not breaking. The white line here is the unemployment rate. It is at 4% as of Friday. It is underneath the 12-month, basically 1 year rolling average of unemployment, and the Tom rule is actually uninverted. It's been uninverted for about 4 months now, 4 cycles of unemployment data. This typically would signal a recession. It is not continuing to signal that the recession is looming based on the rate of change relative. It's the rate of change relative to the last 6-month high and low of the unemployment rate. So there's your Tom rule. The other information we got, which was interesting because it's inflation data, in my opinion, is the ISM services PMI. So you see a downshift happening here and a downshift happening here. This is prices paid and new orders. So the fact that they're not divergent, notice that this blue is prices paid. This big time up where we go sideways here out of new orders, that's inflation actually, divergent interest. The fact that it's down, both in tandem, is not necessarily deflationary, but it's not inflationary. We'll frame it that way, right? It would really depend on the rate of change, and it's just not so obvious when I haven't done the math between the difference of the change between two, right? What is this versus what is this, and which one is this, right? So anyhow, that is services and what we had last week. This is also interesting for food. Buckle up your seatbelt. This is an interesting observation because it is the biggest spread we have seen basically in forever. This is relevant to the University of Michigan inflation expectations. Inflation expectations by political party affiliated. Notice the spread between Republican and Democrat expectations. Republicans think that inflation is going to disappear and go to zero, whereas Democrats think that we are in a new wave of inflation. Buckle up, you're going to be bringing a wheelbarrow full of cash to go buy a loaf of bread. The spread is as large as we've ever seen. Again, this is not a comment one way or another. It's more of just like, hey, what is going on here where the spread has widened this much and the independents are right on the money, right? So I think that tells you something a little bit, what this tells you is that these headlines will continue to drive market volatility. This is representative of market volatility. Massively divergent opinions across the aisle. This is going to be the worst thing in the world for the market. This is the best thing in the world for the market. It doesn't matter where you fall. At the end of the day, for us as traders, it just means that volatility is here and it's not going anywhere. Spreads are going to continue looking like this. So that's the comment there. If we take a look forward towards inflation expectations, we talked about how energy, is likely going to put some downward pressure here. I think that it's very possible to see the, where is the month over month? I just want to make sure I'm looking at the right one. I think it's very possible to see a forecast move, which is your lighter that you see, which is month over month, non-correlated, inclusive of energy, at a point 2. The core, which is excluding the energy inflation, food inflation, volatile categories, is slated to come in at a 0.3. I think that that's something you should watch out for. Noting what we just saw with crude oil, what we saw with gasoline futures, what we saw with the natural gas futures, I think this is spot on the money. I think this is where we'll learn a lot more, specifically around rented shelter. shelter inflation continues to be the sticky one. That's what we'll keep an eye on. Okay, that is what we have. There is some testimony from Jerome Powell. It's the semi-annual monetary policy review. So Congress and the Senate and all that stuff will be peppering in with questions. If you tuned in before, you know that it's 100% a clown show on all sides, and people will just use the opportunity to push their agendas and ask silly questions that I hope Jerome Powell has the backbone to say, like, that is not within my range of expertise, no comment. Just like he did during the Q&A press conference from the FOMC last week, or 2 weeks ago now, it's crazy, losing track of time. I think it was last week. Moving along, earnings. What's going on with earnings? We have this. Market is rewarding positive EPS surprise less than average, and the reason for this, we've been talking about it in pre-market press, is because we have seen horrible forward guidance. Horrible forward guidance, and the market is punishing that. So, there's a couple of interesting things that actually does. It does set up the opportunity for a stronger beat, but it's seriously pulled down to the bottom end of the report here. What I want to get to is this. Quarter-over-quarter, so here's the expectation for Q1, what we're currently going through right now, which will be reported obviously in the future. There's a possibility of this. If we do see interest rates come down, if inflation is a non-issue, if the tariff talk and volatility ends up sort of blowing past, and maybe there's not as much concern about foreign exchange and guidance policy, that's really what it's been. Strength of the US dollar, right? Maybe we can see a beat here over 15, 20, 2025, which in theory would be bullish for a number of the stocks out there, and it certainly gaps down on earnings and primarily about the tech focus. So that is your calendar, or sorry, that's not the calendar, but that's the forecast from the report here. And I also think it's in a very top, people kind of crazy. You see a record number of companies, at least over the last couple of years, starting to talk about tariffs on the fall. It's very reminiscent of 2018. Trump's first term, when he first started talking about tariffs on Chinese goods. So we're getting back into that realm. If you haven't been adapting to the Trump market, the Trump administration market, then it's certainly not an easy one to trade, right? Obviously, you have to stay very nimble, but those market intelligence should be helping us continue to watch today. Take a look at the earnings calendar for this week. It's loaded. Nifty B to gold market before we open on Monday. Speaking of Monday, it's Monday.com. It's not something you're watching, but McDonald's certainly interesting area and interesting perspective about both the American consumer, right? Lattice is interesting down here. That has to do with semiconductors, of course. As we continue along, Shopify is usually a decent trader around earnings. Coca-Cola, Warren Buffett's favorite. You can see BP and the energy side of things. If you have any comments about inflation on that, I would say Super Micro is not really a top watch, given all of the controversy around the stock here. Might just be a popcorn arm, if you will. Gilead should not be forgotten down here from a healthcare perspective.
What's up, Steezy? Go get one.
Well, healthcare there. Reddit will be interesting to outlet, and Robinhood, I'd say that those are your top three there. As we move along, ECG should not be forgotten. Cisco is a long walk. It's not worth walking. Datadog on Thursday, Coinbase. Really, the chart is very, very impressive. And AMAX from a foundry perspective on semiconductors. Palo Alto, why did it not include that higher up the list? Because it seems to be definitely overdrafted. So, Moderna here on Friday before the open, lowest tier watch. But those are your honorable mentions this week. We're getting, we're through a majority of the magnificent stuff. Obviously, NVIDIA is the only outstanding one there. So, that is what we have. Let's take
all right, guys, what y'all think about this cover up?
Our market is continuing along with our analysis. As mentioned, the TLT, if it breaks the trend line, could go on a little bit of an outperformance here, which would be a flight to safety style move. We're not all the way there yet, but it's something to keep an eye on. As we take a look at bonds relative to themselves, this is actually confirming a little bit more of the thesis that I've outlined so far, which is that inflation expectations are almost unhinged on, or the response to inflation expectations were unhinged out of the market on Friday. If you look at bonds relative to themselves, I mean, the shorter end of the curve is not getting the love. It's not seen as being outperformative of the longer end of the curve here. So those expectations, again, market's response a little aggressive, seeing continued downtrends developing out of these bonds relative to themselves. Moving along to the credit spreads, volatility.
Oh, thank you, sir.
Absolutely. So
Kodak Ink
not
fishing.
out of the woods, but definitely not along. Let's frame it this way. If you zoom out, charts have been moving from the upper left to the lower right. Upper left, lower right. Is it, oh my goodness, the market should crash? No. So more of a neutral, if not bullish data point, honestly, when you zoom out on those. If we look at HYG in isolation, it's sort of mirroring the market here with a lower high into the end of the week there. And we take a look
Y'all
at
subscribe to me if you ain't already subscribed.
divergence. Notice the higher high versus the lower high happening here out of the SPX. So interesting stuff, and probably
Use your phone, take
see
It's on 3% though.
probably supports a bullish neutral edge. Bitcoin as a risk-on asset still looks great.
Open my camera. Can you see the back of the camera?
You have the bearish signal out of the Sailor Ship tool. If you want that, it's available over on our site. Let's even drop it down to a daily time frame chart. Let's get granular here. So the tariffs on the Monday session certainly caused for concern, right to the area of support that needed to hold, and what happened? It held. If Bitcoin breaks underneath 92,000, I would look to NSTR MicroStrategy, which is no longer micro, it's just strategy. I would look to that for a possible short. As an idea, it's underneath 360 as a balance range, right? What else? Breath. Take a look over here. Breath rolled over a little bit into the end of the week, a little bit into the end of the week. This neutralizes the data points, right? It's not outright bearish. We did not have a negative print here. We are underneath the 50% mark by a hair on the 50 SMA blue moving average line. 200 is still above. So again, neutralizing data point there. As we look at the RSP, it is still over.
Oh my God.
Resistance, top end of the range, acted as perfect support via the gap down on Monday. I like that. So far, still bullish here out of breath. We take a look out of the equal weight NASDAQ. We are also still above this key area from in the past, just as a relative measure, right? We wanted to make sure we stayed above, even though this drawdown was much deeper underneath. So all set on the equal weights. As we take a look at volatility, notice that we are at the 15 floor. It's tended to after the floor. We'll see if it spikes here into the Monday session, depending on what fun and games we see over the weekend. Let's see what we have out of the VVIX. Same concept, looking like maybe we found that floor. There's a new floor here at 95. And most importantly, let's move along to our volatility futures. It's really light the way here. This has been nothing but hopeful over the last little bit. So any conversions out of
switch up to the other one.
Ooh.
any conversions that cross through the zero mark.
Dad, can you use your charger?
Way back months. Volatility pretty flat and stable here. Market seeing some short-term volatility, but nothing to be overly concerned about in the long term, is sort of what this chart would represent, without any of these crossing underneath the next most dim level. With that, I think it's time to move along into our core list of companies, and then I have two trade items
Do I want it to
for you.
work?
With
Yeah.
back up.
Oh, I thought it would be
The 60. Oh, no.
Look back at another screen.
16.
Anyway,
I don't like the
video.
update.
Right, it's time. It is time. 129 was a huge overhead supply. We started to close that area as of Friday, which I found very interesting, noting that the market was down on Friday. So it's possible that NVIDIA, maybe after seeing this look below and fail, is ready to continue on a full gap close towards that 175 area. It's possible. Now, I would just remind you on the hourly time frame chart, you've basically seen a wall-to-wall move from point A to point B. There has been no major daily pullback for a higher low. So, if you're buying this at the tippity top of the move, are you setting yourself up for the best risk reward opportunity? Probably not. So we tend to think that if it does pull back, that's where we would go through on the second attempt in short proximity of time. If we just get a move that goes through the pullback above, now at least
So serious, boy.
but just longing this here for the sake of longing it means okay, we close over 129. Seems like that might be a little bit malin form this form. I would prefer a slightly better risk reward opportunity. NVIDIA honestly has stolen my heart over the past week, so gotta be careful not to revenge trade this. But the 129, 140, 175.
Is there an outlet near me or no?
Play trade relative outperformance on Friday. Decent. Microsoft, what do we see over here? It's done nothing for a number of years. We've known that. I shouldn't say years, a number of months. We're near the bottom end of the range. What looked like it was starting to act as support earlier on in the week, of course, was shattered. Hopes and dreams were shattered
in the
on
morning.
Friday, and we have closed underneath 411.5. So on the hourly time frame chart, you can see the name of the game.
So the foot hurts worse.
We're just looking for lower highs here, or I would even entertain lower highs here. If we can continue to see rejection off of 411.5, 414.50, I would be looking for short-term moves into 403.25 and reevaluating when and if the market approaches that. Not really interested in a look below and fail. That was what really should have happened right here. If this was going to play out, right in the left, head, right. Obviously no love over the neckline on the Friday session. Let's move along to Apil. See what's going on with the one stock to rule them all. This is back the heaviest weight component of the S&P 500. The lower high is in Lower high is in underneath the earnings gap up day, which was a nasty bearish engulfing bar, and we're still
They say my
underneath
feet
the
ugly.
key level. Nothing bullish to say about this chart. I would not be trying to fish for longs down here. To me, looks like an opportunity to say, okay, we have a beautiful H pattern, and we are looking for the possibility to break through the equal lows to set the move into 219.75. When we get towards this area, I would not be seeking new money shorts. The daily 200 SMA is not something to play around with. As we can see from in the past, this will be the first test in a very long time. Right? First test, best test. Second test, if we reapproach, we're sort of still in the neighborhood of the possibility of a response from that via the buyers, right? So that's what we have out of Apple. Let's move on to Amazon. The overhead supply here is concerning. The fact that it was a perfect gap fill reversal on Friday is sort of a lot of these things almost happen too quickly to participate in on the
A little
consumer
bit
sentiment
more.
and inflation
Yeah,
expectations
maybe
move.
that way is better.
So ideally, it's just this, right? Show me some sort of lower high here, and we'll trade it to the downside. Unfortunately, Jeff has been very lucrative and very good to us through these past couple of days, but we might have to flip it up and trade some short side here if we can get risk reward along these lines underneath 230, 250 into that 225.25 thin structure retracement from back over here. So firstly, seeking the lower high, something that looks like this, daily 50 SMA, changing tone when we get here. Is it possible for support? The answer is absolutely. Here it is on the daily. We'd be trying to support over this major low. Let's move along to Google. Earnings here causing some havoc, but just at the bottom end of the range. So the ideas here should probably be more so along the long side, saying, is it possible that we see a look below and fail? Is there an intraday higher low that can be found over 185.25 at the bottom of the balance? If that's the case, on the hourly, it might look something along these lines, where it appears
No shading, right? Okay.
Oh
God. Oh my God.
and then you have a double bottom, right? So there's your double bottom. Back into this range is probably what we're trading for, and then bulls, show me this, right? I was really more so interested on Friday in the possibility of opening inside the 2-bar range. This for a bull there, no dice. So we'll see if that is a back burner idea that will come into play over time, or if we drop from the overhead range and just look above and fail, which is complete to the bottom end of the target. If that is complete and we are going to continue to see downside, it's all about the willow gap, right? Remember the quantum computing gap from back over here. This probably represents in the higher time frames a better buying opportunity on that gap fill reversal area in the daily 200 SMA out of Apple at 176.35. Sure. Move on to the metaverse, one of the stronger names out there. Amazon was as well as higher than earnings, but now it seems to be. So Meta was a little top heavy. It's been this way for the past few sessions. There's the other red
Top heavy.
series chart. We're still printing higher lows and higher highs. I think this is something like the 15th or 14th consecutive day.
Ain't that bad.
So it's still definitely bullish, but let's keep an open mind for a pullback at some point. Or if further range consolidation finds eventually, so this is the adult we're not chasing this at the highest high with no reference for a potential stop loss. So that's that. If it is going to reverse more firmly, I would really wait for this. 682.25. If that breaks down, I would probably start eyeballing 635.25 from the daily perspective. Right? Where's there some sort of pullback that looks like this for a higher low into the price? It's a very impressive breakout post earnings, but where is this? To really start to make major long opportunity, right? Next up is Tesla. Tesla was weak, breaking down underneath the balance load. So no dice from Mr. Musk, a nice little rejection there on the 377 level into the Friday session. So caught between a rock and a hard place. It's been quite a wide range there, but the reason I say caught between a rock and a hard place is because of this previous breakout level in the past. We've been waiting very patiently for the full reset of 358.50. We actually sort of lost some interest in Tesla previous box back here. But now that we're at the zone, I think it's time to continue to watch this on a day-by-day basis and say, okay, is it possible that we can spot some long opportunities for us to test at 358.50 to retest at the balance highs that we're breaking out of, obviously. So thinking about that, if we do get that reversal, the first target would be the gap close. The way that we look to play this could be some sort of inverted head and shoulders on the hourly that then breaks out what we want to find back into an entry point and looking for risk reward, trying to traverse that range. Idea, if we start to fall back down underneath 358.50, great. We're going to meet there through there and pull that buy opportunity for that just nice sale. Let's move along to JP Morgan, which we've already covered. It's an absolute rocket ship, super demon. And of course, we are hanging out here near the all-time high. Really not much commentary. I will pull back to persist over 270. And you can say about Netflix, not much commentary here because it's doing what it should do. There it is. There it finally is. We have the earnings range breakout. So over 999 as long as it's higher low Okay, we are set to jet out of Netflix. We're pulling up on another screen here. A couple of these today. I told you I had two. I do have two. LLY, Eli Lilly is the first one on the chopping block. Chart looks great as of the earnings breakout. Apologies for not doing my homework. It looks like I did not sit down to the desk before doing all my levels, but it's 840, 850. If we can stay above that, looking for continuation in the upward direction, we had a huge balance range which is broken out on earnings, inside consolidation on Friday session. I could actually get a slightly higher high. That slightly higher high is nothing too concerning. I'll be watching for retest entries for the bulk, if you will, around 840, 850. Can we get something that looks like this? The continuation in the upward direction. Next, if it gives you an intraday breakout of this, so you have the hours for that. The level here is going to be at 885 to 75. If we can go big gold here today, we'll probably look at some upside as well. And your target, full gap close, that's definitely a scalp target, but beyond that, we'll be looking for a scalp up here, close to 935.75. So that's only on that one, only the round. This one at 98.87. So that is Eli Lilly. That is trade idea number one. In a picture perfect world, it's this higher low with your gold for continuation over time and helps the sector recover. The next one is on UAL. We have United Airlines. And I did do my homework on this one step ahead. So this structure is really what I'm paying attention to. I like the consolidation back. You can this level to hold after the gap down on Monday session. So one kind of like this very clean level. If we get over that level, I think that there's nothing but structural crazy is 116. So the reason I like the chart is because the risk reward metrics are very, very clean and easy to identify. So if you can spot the correct setup, if you can entry point that isn't over 110.50, I think that it's very easy to target for you. So this is makes sense in the upward direction. So
Who going fishing tomorrow?
in completely different sectors here. United Airlines and Eli Lilly to end out the video. Thanks so much for hanging out with me on this Saturday before the Super Bowl. I almost forgot that that was even yesterday. I think it's a race. If you do, sure we can start in the comment section, talk to our new team is, and we'll see what the aggregate opinion is of the trade review and see what's going on with the penthouse and whether or not we can have some post-game analysis on Sunday. Anyways, enjoy the weekend. If you learned something new from the video course, simple thumbs up with the comments down below. We'll see you back here in the office on Monday morning, 8 o'clock Eastern time for our typical scheduled episode of the 200 Top. See you there. Get that said, stay green. The tariffs are here, and as the saying goes, our charts are no match for his tweets. But what if I told you the market dynamics were weak, well ahead of the sell-off on Friday? And this is due to not getting wiped out by Trump volatility, or heck, even being able to profit from it. So welcome back to the Trade for Big Weekend show, where we'll take a look through all of the data points, including those market dynamics, and we'll build a logical trade plan. My name is Matt. If you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the chart. So kicking things off in this 5-monthly time frame now that the January calls have officially closed out, what do we see in terms of candle structure and location? In terms of structure, we get a green body bar. However, the upper wick and the lower wick are both substantial, and it's really based on location. Let's segue to location on the bar count. Notice that we have a higher high as well as a lower low, and this is an outside range. We technically closed inside December's range, just a hair below the opening range of the December monthly bar. So in theory, what this suggests is that we don't really have strong buyers.
Subscribe to me if y'all haven't already.
And then close price there. But we also don't have strong sellers, because we technically took out December's low, and the sellers were unable to close underneath December's low. So the green close for January probably gives structure and location a slightly more bullish edge that would start to incorporate a little bit of neutrality into the narrative here. The green close for January also sets up higher likelihood from a statistical perspective for a green 2025, but I'm much more concerned about the structural biggest high in the trend count. So in theory, is it possible that the monthly time frame can afford a higher low pullback? And the answer is absolutely, coming from the highest high. So the next follow-up is, where does the higher low need to stay above? In my view, it's over this level right here, which is 525 roughly. I know it looks pretty aggressive, and absolutely it would be intraday each week, but there's certainly an opportunity for a monthly higher
I'm so
low
sorry.
if we support here, find buyers, and then some price movement in the upward direction. If you don't believe me, the reason I'm calling this level is first and foremost, it's
I don't know
this.
how to get a whole footwork back. I don't know.
But also, if we bring out the Fibonacci from the bottom of the move to the all-time high, is it actually above the Fibonacci 38.2? I would always prefer to see chart structure act before a Fibonacci level, but staying over the 38.2 does classify this pullback as bull flag consolidation on the monthly view. Now, one more time, I want to be completely transparent that, of course, on the daily or even weekly time frame charts, there will be short opportunities if that pullback emerges. However, the key word in that sentence is if that pullback emerges. I want to talk about the strength of the trend here by bringing out the 20 SMA on the monthly time frame chart. Notice the distance between price and the 20 SMA. Notice also how the 20 SMA might lead us there for confluence around that 525 if a deeper pullback emerges. Now, beyond that, if anybody's calling for Armageddon market crash, oh my goodness, we tested the all-time high, but we didn't close up there, I will just point to the fact that we do this every single month, right? Let's go back to our classic examples of the great financial crisis, and let's take a look. When does the painful moment happen? It's after the monthly trend flips to down. We had a double top. Notice that we've already tested the monthly SMA. We form a lower high on the monthly time frame chart. We form a lower low from here to here, and then really bad things happen in the market. So does this look
Subscribe to my channel if y'all haven't already, guys.
We can of course do the same exact thing with the dot-com bubble bursting. And so the Dow Evolution thing is going to be a housing crisis, right? We can use this comparison and notice that the chart almost looks identical. You have a double top, you have previous lows that are very close to the monthly 20 SMA. You form a lower high on the monthly chart, a lower low on the monthly chart, the monthly trend is down. And then we see painful moment number 1, 2, and the big one down to number 3, the capitulation breakdown. So if we compare these two looks to what we're doing with currently in the market, the trend here is far stronger and in a much better place. One counter argument that might suggest a pullback could be imminent is just the idea that we have completed a measured move from the biggest bull flag I think I've ever seen. Right? If you take the move from the sickness low point A to the rally high point B to 2022